It could be seen over the past couple of weeks where the Dow, after having a steady uptrend above the T-line, had a sell signal, a shooting star, and a close below the T-line. Told you there was a pullback. Then it bounced back up above the T-line, which told you should be back in an uptrend, with one little suspect element. Notice that this candle right here is not a reversal signal. It's not a bullish engulfing signal. It's not a bullish harami. It's basically just an up day in a downtrend. So that should have alerted everybody to be a little bit more skeptical about whether this was going to go into new highs. The fact that they brought it back down below the T-line told us one simple factor. We're probably heading down, and the first target is here at the 50, which would also kind of correlate with acting as support at the recent resistance levels. And what made the reversal more compelling is witnessing what was going on in the NASDAQ. Usually the Dow and the NASDAQ never had days where both of them were closing below the T-line at the same time. However, a couple of days ago, or was it yesterday, we had dojis at the top and then a close below the T-line at the same time that the Dow was backing off below the T-line. So that was the first time that both of them were moving in conjunction with each other. That was a good indication that it was time to take profits on long positions that weren't showing any great strength and starting to go short. Although the markets were heading down or still in a downtrend, there are charts that show compelling buy signals. For example, our recommendation on MILL was predicated on the left-right combination with a booster bullish engulfing, a close above the T-line, which told us that if they opened positive, we wanted to be buyers. And that would also confirm our J-hook pattern, as well as breaking out through recent highs, makes our upside potential the same magnitude move as this move right here. However, it makes more sense to go with the flow. We shorted TDC the other day when we saw the doji gap down. Remember, a doji followed by a gap is your best friend. And we can see that this is a strong move to the downside, which means if this was wave 1, this is wave 2, wave 3, starting with a strong gap down, could be fairly substantial. And this would, again, be going with the flow of the market. And once again, the reason that we go after price patterns is, as we can see in this fry pan bottom, the price still moved very strong today in a very weak market, and it's been moving strong in the over the past week in this weak market, because the elements that are making this fry pan bottom are not regarding what's going on in the market in general. It is specific to this price action. So quite often you will see strong price moves coming out of patterns even though the market is very soggy. This is the advantage the candlestick analysis provides, is it allows us to still be in good strong positions even when the market isn't providing any bullish opportunities elsewhere. It also makes for the dumpling top, which is the opposite of the fry pan bottom, a slow rounding top that tells us that if they break this level, there's going to be a very strong downtrend, probably to the magnitude of hitting this downtrending channel. So using the candlestick signals and being able to interpret what each individual signal tells us makes playing in the patterns much more powerful. That'll be it. We'll see you in the chat rooms.